Welcome to Purple Chips Update number 258 for November 11th, 2017. I'm John Schwinghammer, the author of Purple Chips, published by Wiley and available everywhere. Please pause your video to read our disclaimer. I was reading the Globe and Mail this week and I came across an article on Canadian Western Bank, and it made me think about the movement in stock prices and how sometimes investors can get it wrong and how we get swayed by what the news is saying. Towards the early part of 2016, when oil prices were dropping, Canadian Western Bank dropped to about $20 a share. Now I look at the price today and the price is roughly around $35 a share, and that's a pretty big difference, $15 on a $20 stock. The point is that sometimes the market does get it wrong, and sometimes it takes time for stocks to get back to what their fair value is. Now what happened was the earnings in Canadian Western Bank were dropping during that period, but then they recovered quite rapidly, and now the outlook on Canadian Western is pretty good. The papers hated the stock before, now they actually like it. As an investor, sometimes it pays to be a contrarian. Which brings us to our next stock, Enbridge. I know a lot of you are saying that the earnings have been pointing down, and this is a case where Purple Chips normally we would have gotten out, and you're right. But in this case, we have enough data to suggest that the odds are very, very good that this stock will recover. I do believe that the stock will get back into a nicely profitable position, but we're going to have to suffer through it. Enbridge is a very good company and they have a fairly good predictability in their earnings, and so I think we will see the stock recover. I don't think we should be too alarmed. That's our position on Enbridge. Most of the analysts are still fairly positive on the stock. The targets are much higher than the actual price. In ups and downs, still quite a few stocks on the radar there, including on the TSX we've got Loblaws. Our Scotia strategist talks about how the earnings for the S&P were good, but they were impacted by hurricanes. You can pause the video to read through his commentary, and you can look at his accompanying slides on S&P 500 earnings. In progress trades, a couple of changes this week. We took profits on Great-West Life. We made about 7.5% when you include the dividend. We also sold Couche-Tard on Thursday at 64.07. We made 11.7% on that. In both those cases, they're not stocks that we held a long time, probably about 6-7 months, which isn't a very long holding period. But I think we had good reasons to move on both of them. The one that really comes to mind is Couche-Tard. I like that stock a lot. The reason we made the decision to sell it, originally our target was a little bit higher, but we reduced the target to 64. The reason that we did that was because the PE multiple is still in the 20s. It's around 22 times earnings. We've been seeing a trend towards contracting PE multiples, and so I think there's a risk that the Couche-Tard multiple could get under 20 times earnings. And the other thing that's very important is that their debt level in the spring was around $2 billion when we took on the position, and now the debt level is around $9 billion. That's a pretty big difference, so I was pretty happy to take the gain and hope that we do have a chance to buy it at a lower price in the future. In conclusion, I'm John Schwinghammer, the author of Purple Chips, and I want to wish you a happy Remembrance Day. Thank you.